Let's get some insights on news shaping the markets. William Lee is with us, Chief Economist, Milken Institute. Thank you so much for being here. Today is Fed Day. No one's expecting the Fed to make any moves, but they could make moves, for example, on running off that balance sheet, maybe doing less with treasuries, for example. What do you think we might hear today?
We're going to have to hear something from Chair Powell that says that he's not confident we're going to get to 2% by the end of the year. I think he's going to put the market on notice that right now the inflation has been stuck so high above the 2% target, especially in services, that he's going to warn the markets that not to expect anything possibly till beginning of next year. What's happening with the economy, though, is that we see a lot of strength, apparently, especially in the labor market. But I think one of the things that the traders out there should keep an eye on is that not all of the data from the labor market is all that strong. Even today, we had job openings start to come back in a bit. But more importantly, for the last 4 months, the employment survey showed that only 94,000 jobs on average has been made per month, not the 290,000 that people were talking about. And that's because we have two surveys. When you ask people, do you have a new job? There aren't too many people who are saying we have a new job. But when you see payrolls, we have a lot of jobs. And the reason for that is because people are getting many jobs. And the type of jobs that are being made is in the leisure and hospitality sector and government. These tend to be lower paying jobs. And so people are finding that they're having a hard time making ends meet. So there is some weakness out there, and I think the Fed knows that. And so we're not going to be worried about rate increases. We're not going to be worried that the Fed will reverse its posture. But what we should worry about is the timing of the next rate cut. And I don't think we're going to see anything until very close to the end of the year.
So September is at right now 39.4% likelihood when you use that CME Fed Watch tool, Fed Funds Futures. Where do you think we might see the cut, and how quickly would you like to see the Fed cut, if at all?
Being an old Fed staffer, I agree with the Chair Powell's assessment that we shouldn't be premature. Right now, the worst thing they can do is a policy mistake where they cut prematurely, and we still see service inflation hanging out at 4%. One of the things that is always hurt the Fed's reputation in the past is that they did things at the wrong time for the wrong reasons. They just didn't get the economy right. And right now, the Fed needs to make sure that their decisions will not have to be reversed in the future. The last time we talked transitory inflation, they got burned. And now they want to make sure that the decline is not transitory.
So that would be a policy mistake, in your opinion, and that they don't want to have to do something and then undo it. I see what you're saying. In the meantime, you do have concerns about, even though we have a good labor market, within the labor market, you have some concerns. Some people are carrying on multiple jobs, right, to sort of make ends meet because the inflation environment is still pretty hot. What do you say to folks who want to invest in the market, in commodities, different sectors? What do you tell them? I mean, in relation to how the economy could move?
I hate to sound like an echo of all the other analysts that you've had on the show, but the best place for investors to look is the places where we'll be improving the productivity of the economy. Right now, the one thing that makes the U.S. economy distinct from every other economy in the world is that our productivity is still very high. And it's one of the most attractive places in the world to invest because we have technology really going like gangbusters, especially in the artificial intelligence field. That's the one game changer that will revolutionize how much people can be paid for the amount of education they really have. I gave a talk in Silicon Valley not so long ago where I said the challenge to software developers is to make people much more productive than they are. Someone with a high school education with the right equipment and the right kind of software can actually be more as productive as a PhD. And right now, that's the one thing that we need because family incomes are starting to go down. For the last 4 years, family income adjusted for inflation has actually declined by 5%. So there's a lot of discontent out there, especially people at the lower end of the pay scale. And productivity is the key to everything. And that's where I think all investors should be looking.
Yeah, without a doubt. I mean, also, how could the election, we have the Biden administration, and if you have a Republican, if it's President Trump, I'm less interested in politics, but more interested in policy and how it could affect folks. What are some things on your mind for November and how it could change either for the better or for worse, in your opinion, for folks?
I think the onshoring trend is going to continue no matter who is in office. Our competition with China is still very severe. And one of the things that we have to make sure of is that we stay on the leading edge of technology. China is posing a big challenge in terms of artificial intelligence, electric vehicles, and so on. And I think one of the things that the new administration, whether it's Republican or Democrat, is going to do is to make sure that we incentivize companies to invest in the leading edge technologies that will raise people's productivity, increase incomes, increase wages, and I think those are the areas where I think that we have to look at the regulatory environment. For example, a lot of people talk about Elon Musk's electric vehicles and how self-driving is going to make this revolutionary change, but don't forget, insurance companies have to give their okay for self-driving cars, and we have 50 state regulators for insurance. So there's going to be a huge regulatory hurdle out there. And I think one of the things that policymakers are going to have to do is to say, let's coordinate our policy, let's coordinate our regulations, let's make it so that it's easy for new innovations to come online and make people more productive and give them more income.
Yeah. And I'm going to leave the last question to you, because when I look at the big border, I see certain prints. I have 4.64 for the 10-year. The dollar has been pretty strong for the most part.
Yeah.
Oil is sitting at $80, and Bitcoin has pulled back below even 60,000 now. Care to comment on any of those and why people should pay attention? Why should they care?
The one thing I would still focus on, like a hawk, is what the Fed does. Where's the real interest rate? The 10-year adjusted for expected inflation over the next 10 years. If that stays at a high level of 2 plus, then it's going to be very hard for American industry to finance its innovations. Now, fortunately, we have a lot of companies where they're cash rich and they don't really need to borrow right now, but that's not sustainable going forward. One of the other things to look at would be actually Bitcoin. The more people focus on Bitcoin and think of that as a viable investment, it questions the sovereignty of countries, and the geopolitical risks will be very high. So for me, that's a counter indicator. Whenever Bitcoin becomes an attractive investment alternative, then there's something wrong going on with the world, and keep an eye out for that.
Right, as the risk indicator. Do you think the 10-year can go to 5% anytime soon?
If the expected inflation rate keeps going up like this, yes, absolutely, and that depends on what's happening to the service numbers. If we see the service number inflation come back down below 4%, and it hasn't so far, then we will have a top on the 10-year. But if the inflation rate on services continues to chug along at 4%, then I think there's a very easy chance that we'll hit 5, because we have a lot of refunding issues coming up at the second half of this year. Given the federal spending that's going on and the Treasury needs, there's going to be a lot of issuance.
All right, Billy, thank you so much of the Milken Institute. Wonderful to see you. Thank you for being here with us on
Nice
a big day. Thank you.